we will be discussing a very interesting valuation of inventory question, which not just comprises of stock reconciliation, but this question comprises of goods sent on return or approval basis, and goods sent on consignment basis, goods received on consignment basis, stock sold but returned back, meaning sales return, stock purchased and returned, that is purchase return, and goods sold at a price not usual to the normal rate. Abnormal sales is also there in this particular question. Only thing missing, there is defective units also. There is abnormal units being sold as well in the question. That's what I just mentioned. And that's it, a very interesting one, wherein the physical verification of the inventory has not happened on 31st of March, that is year end, but for whatever the reason that they had, they've done it on a date after 31st of March, that is 7th of April, and we are going to compute the value of inventory to be disclosed in the balance sheet as on 31st of March. I hope you're all ready. So why waste time? Let's get started. Let's read the question. Determine the value of stock to be taken to the balance sheet of PCT Limited as at 31st March from the following information. Very good. The stock was physically verified on 7th of April and was valued at rupees 4 lakh. So what is the value of stock? 4 lakh. After 31st March, the following transactions have taken place till the date of stock taking. So value of the inventory as on 7th of April is 4 lakh. Keeping that as a base, we need to come back to 31st of March. What we need to remember at this point is we're coming back in time. We're starting from 7th of April, coming back to 31st of March. In a forward approach, when we go from 25th of March to 31st of March, we add purchases, we deduct sales that is happening between 25th March and 31st of March. Between two dates, if we're moving forward, we add inflows, deduct outflows. However, if we are coming back in time, backward problems, what do we do? It is like reverse. It is like reverse. Inflows should be deducted, outflows should be added. Inflows should be deducted, outflows should be added. It is like I'm going forward. When I'm going forward, what do? I purchase, I sell, and I arrive at the later date. If I'm coming back in time, I sell, I purchase. You get that? Purchases will be deducted, sales will be added to arrive at the stock in backward moment. I hope you got this. Now come on. Using this logic, let us solve this. We are required to identify the value of inventory on 31st of March. Let me start with this. We are doing it in the books of PCT Limited, and we are preparing a statement showing computation of stock as at balance sheet date, that is 31st of March. Year is not mentioned. And starting point is, we know the stock as on, whenever I am finished reading that line, I'll mark it with yellow. Yeah, the stock was physically verified on 7th of April and was valued at rupees 4 lakh. 4 lakh is the value of inventory. So let me take 4 lakh. 31st of March. Sorry, file got closed. Yeah. So what are we trying to find? We're trying to find the our starting point is stock as per physical verification as on 7th April. Stock as per physical verification as on 7th of April. This is 4 lakh rupees. This is our starting point. We've written this. Now let's read our first adjustment. What does it say? Purchases of rupees 2 lakh. Now purchases is inflow. That will increase the value of the stock. But we're going backward in time. We're going back in time. So this stock was not there with us on 31st of March. We purchased it between 31st of March and 7th April. So when you take physical inventory on 7th of April, the stock is there, but it was not there on 31st of March. So starting with the stock was on 7th of April, when we deduct these purchases, we'll arrive at stock as on 31st of March. That is the stock that needs to be shown in balance sheet. So purchases is inflow, we are going to deduct it because this is a backward problem. You get that? And then they've also told us some information that 20% of the goods were returned. So between these 31st of March and 7th of April, we purchased 2 lakh worth of goods. We returned 20% of it. So what we have with us, on 7th of April is 2 lakh minus 20%. That is 2 lakh 40,000. If we deduct 1 lakh 60,000 worth of goods are there on 7th of April, but they were not there on 31st of March. To move from 7th of April to 31st of March, what should we do? We should deduct that 1 lakh 60,000. Shall we? Come on, let's do it. I'll write here less. How much should we deduct? Purchases between 1st April and 7th April, net of returns. Okay, I'll do 2 lakh minus 20% straight away. That, my friends, is 1 lakh 60,000. This is deducted. I hope you guys understood this, and I hope you guys don't have any trouble with this. And throughout when I did this, I'm doing under an assumption that you know basics of valuation of inventory. And if at any point of time, if you don't know any parts of basics of this chapter, you can always ask me and I'll be able to help you out. If not, if you want basic conceptual understanding, theoretical understanding of any topic, all the 10 chapters of your CA foundation, I've covered it in about 6.5 hours, a marathon revision. And the videos are there in the same YouTube channel where you're watching this. You can go back and then watch that marathon revision for that specific chapter and you'll be able to understand. If not, you can always drop in by way of a message to this video in the comment section and I'll come back and then cover that part up for you in a video. Great. Got it, guys. Let's go ahead. Next one. Sale of good units. Sale of good units, rupees 2 lakh. So between 31st of March and 7th April, you have sold goods. When you sell goods, 31st of March stock is there, no? 7th of April stock will be lesser than 31st of March. Stock as on 31st of March is there. From that, when you sell goods, 7th of April stock has become less. So it is outflow, resulting in lesser stock on 7th of April. So if we know this and if you have to find this, to the 7th of April stock, we need to add the sales that is made between these dates to find the stock as on 31st of March. Or in our logic, sales is outflow of goods. If you are going forward, you would have deducted. This is a backward problem. So outflow of goods will be added back. I need to add it. But a very important point to be noted is unlike adjustment A, adjustment B is about sales. Whenever you talk about sales, sales will involve profit. And when we value inventory, it needs to be done at cost. So with regard to this sales value, we need to eliminate the profit element, determine the cost element, and such cost elements should be taken to outer column. Let me repeat. Whenever you talk about purchases, it is all easy peasy lemon squeezy. But when we talk about sales, it will involve selling price, not cost price. In order to find closing inventory at cost price, we need to eliminate the profit that is involved in this sales value. So we should write sales minus profit element in that, identify the cost and then write that cost in the outer column. I hope you got it. So let's do that. They've given sales of good units rupees 2 lakh, out of which 20% of the goods were returned by customers. So we gave goods to them, 20% they gave it back to us. So what we sold is only 2 lakh into 80%. So adjustment should be for 2 lakh into 80% after adjusting profit element. Let's write that. Come on. Let's write. Add sales between 1st and 7th of April, net of returns. At selling price, it is how much? It is 2 lakh minus 20%. 2 lakh is the sales minus 20% because of the goods being returned. If I do 2 lakh minus 20%, 40,000 will get deducted. I'll get 1 lakh 60. And on this, I need to deduct my profit. How much is the profit? We don't know here. It is not given in adjustment B. But if we come to the end of the problem, in the notes, they have mentioned very clearly that goods are sold by the trader at a profit. At a profit of how much? 25% on cost. When I say 25% on cost, it is 1 by 4 on cost. So that would be nothing but 1 by 5 on sale. Can I say 1 by 5 on sale is nothing but 20% on sales? I hope you are aware of this part. Yeah, 1 by 4 is the margin on cost. 25% means 25 per century. 25 divided by 100, which is 1 by 4. And on sale it is 1 by 5. 1 by x on cost is 1 by x plus 1 on sale. So 1 by 5 on sales and because it is 1 by 5 on sales, you're going to take 20% on sales. Got that? So it is 20% on sales. We have the selling price ready here, 1 lakh 60. Shall we eliminate the profit? Profit is 1 lakh 60,000 into 20%, which is 32,000. If I deduct 32,000 rupees, I would get how much? 1 lakh 28,000 rupees as the cost of goods sold net of returns between 1st and 7th of April. Meaning 1st of April stock was more than 7th of April stock by 1 lakh 28. We know the stock as on 7th of April, using which we are trying to find the inventory as on 1st of April, meaning 31st of March. So to 7th of April's stock, we'll add 1 lakh 28,000 and arrive at stock as on 31st of March. Got that? I hope you did understand. Let's now go to adjustment C. We are done with this B. Let me mark it yellow. Come on. Sale of defective units rupees 1,80,000 at 10% less than normal selling price. Firstly, I'll tell you how similar is this with the previous one. The similarity is previous one was sales. This is also sales. Sales means outflow of goods. Goods have gone out. Stock will reduce if you're going forward. This is a backward problem, so we need to add it back like previous problem. Previous problem also had profit element because it's at selling price. This is also at selling price. We need to eliminate profit in both. This is the common part. How is this different? The different part is in adjustment B, the sales is of good units. In adjustment C, sales is of defective units. Because the units are defective, what happens is you have not sold it at the regular sales margin. You sold it at a price which is 10% lesser than the normal selling price. Usually if you sell it at 100, here you sell it at 90. When the selling price decreases by 10%, margin also will decrease. Do you get that? So the cost of the goods will be different. We can't write like last time 1 lakh 80 minus 20% on 1 lakh 80. If we deduct, we'll get cost. No. It will be different. Here what they've given 1 lakh 80 is selling price. And this 1 lakh 80 is 10% less than the normal selling price. Normal selling price is 100. Abnormal selling price is 90. How did we get 90? 100 minus 10%. This 90 is 1 lakh 80. How much is 100? 100 rupees is normal selling price. Defective goods have been sold at a price 10% less than normal selling price. So 100 normal selling price less 10%, that is 10 rupees. Abnormal selling price is 90. This 90 rupees is equal to 1 lakh 80,000. 1 lakh 80,000 is sale of defective units. So 1 lakh 80,000 is 90. How much is 100? 1 lakh 80,000 into 100 divided by 90. If you do cross multiplication, you will get it. You get what I'm trying to tell? When you do such cross multiplication, whatever you get is the normal selling price of the units. For normal selling price of such units, we'll eliminate the profit, identify the cost of goods sold, and that will be added back. Let me show this to you with the help of numbers. See, usual selling price. Let me put it here. Usual selling price is 100, or I can say normal. So normal selling price is 100. You get this? Then selling price of defective goods is 10% less, 10% lesser than normal selling price. So can I say this is 90? And these defective goods have been sold for what rate? It has been sold for 1 lakh 80,000. Have a look here. It is sold for 1 lakh 80. So let me tell. One lakh 80. It is 1 lakh 80 for 90. How much is it for 100? How do you find this? You can do this way. If it is this much for this much, then how much for this much? ಇಷ್ಟಕ್ಕೆ ಇಷ್ಟಾದ್ರೆ ಇಷ್ಟಕ್ಕೆ ಎಷ್ಟು, ಇಂತಕ್ಕೆ ಇಂತೈತೆ ಇಂತಕ್ಕೆ ಎಂತ, ಇವಳಕ್ಕೆ ಇವಳೋನ ಇವಳಕ್ಕೆ ಇವಳೋ, इतने में इतना तो इतने में कितना, ईतक ईतांडा ईतक ईत, अका कितल जलर तक कितले, तमिल ओवर तुलु ओवर कोंकणी ओवर, Kannada, Telugu, English, Hindi over. If you want me to tell in any different language, please let me know in the comments. I'll try to learn the language and then tell it to you. So all you can do is 1 lakh 80 into 100 by 90, by which I hope you will appreciate this number. 2 lakh is the normal selling price. If these goods were not defective in nature, we would have sold it for 2 lakh. Because they are defective, we've sold it for 1 lakh 80,000. Now, come on, let's solve this one. And on that 2 lakh rupees, you will eliminate the profit. We don't know the profit margin for defective goods. Which that adjustment is just done. See, it is sales, so usually outflow, but we will add back in this case. Let me add sale of defective goods at reduced selling price. It is 1 lakh 80. At normal selling price, it is 1 lakh 80 multiplied by divided by 90 into 100. That will give you 2 lakh rupees. I'll eliminate profit, that is 20% on sale. 2 lakh into 20%, because 20% cannot be applied on 1 lakh 80. That is 40,000. If I eliminate 40 from 2 lakh, my sale cost of goods sold, cost of defective goods sold will become 1 lakh 60. 1 lakh 60. So this is the cost of goods sold. You guys get this? I hope you did. This blue part is just the adjustment part. I would say to make you understand. You in fact don't have to write it in the exam. If you write it, cool. If you don't write it, it's okay. What's there in black is part of your answer. So we've successfully finished the third adjustment. Now we can go to fourth one. On 26th of March, goods of sale value 2 lakh were sent on sale or return basis to a customer. Remember, whenever the goods are sent on sale or return basis, you have only transferred the possession of the goods, not ownership. You have the ownership, you have given the possession of the goods to the other party for him to sell. Very good. The period of approval being 2 weeks. From 26th of March, you've given 2 weeks. That falls in the next financial year. Yeah, 2 weeks is about 14 days. So 30th of March, then first till 9th of April is the time that you have to basically for him to return these goods. If not, he has to accept and then pay. Okay, the period of approval being 2 weeks, he returned 20% of the goods and approved 80% of the remaining goods on 6th of April. So he has returned 20% and he has accepted 80%, but both of it is happening on 6th of April. Both of it is happening on 6th of April. Remember the dates. You have sent the goods on 26th of March. He has time till 9th of April, but he has returned 20% and accepted 80% on 6th of April. What we are concerned about is 31st of March, which comes between 26th of March and 6th of April. As on 31st of March, what is the status of these goods? Is the goods sold or not sold? The nation wants to know who has the ownership of these goods on 31st of March. The question is that. Now, he has time till 9th of April to return or accept. So, as on 31st of March, the goods have been given to him. He has the possession. He can either accept or return. Did he give confirmation by 31st of March? The answer is no, he hasn't given any confirmation. So, because he has not given confirmation and he has not returned, entire value of 2 lakh sale value worth goods belongs to us. Let me repeat. As on 31st of March, goods have been neither returned nor accepted, nor has the time period to return has lapsed. So entire goods will belong to us on 31st of March. And we have to include entire 2 lakh sale value goods in our stock as on 31st of March. Do you agree? Entire 2 lakh sale value goods will belong to us on 31st of March. So we have to include entire 2 lakh in our closing stock. But we are not doing physical inventory valuation on 31st of March. When are we doing valuation? Our inventory valuation is postponed to 7th of April. 7th of April, when I physically count the inventory, it was 4 lakh rupees. On 7th of April, when I physically count the inventory, it is 4 lakh rupees. And before 7th of April, one day before I physically count the inventory, he returned the goods to me. How much? 20%. See, they have given here. 20% of the goods he has returned to me. So 80% of the goods is lying with him. So 20% is already received by us on 6th of April. So on 7th of April, when I count the inventory, 20% is already included in the physical inventory. So 20% of this 2 lakh is included already in 4 lakh. So what I should separately include now is only remaining 80%. Let me repeat it to you. The goods have been sent on 26th of April. They are partly returned and partly accepted on 6th of April. The time with him was till 9th of April. We are concerned about the date 31st of March. As on 31st of March, these goods are neither sold nor accepted nor has the time period for returning lapsed. So 100% of this 2 lakh worth goods will belong to us, and we have to include 100% of these goods in our inventory for showing such inventory in the balance sheet. I hope you understand it here. Of this 2 lakh worth goods, he returned 20% to us on 6th of April. So 20% of the stock has come back to us. We didn't count the inventory on 31st of March. We counted the inventory on 7th of April. So when we count on 7th of April in our go down, 20% stock is also counted. And our starting point is this stock value that is there in the go down on 7th of April. So this 4 lakh rupees already includes 20% of inventory. So now we need to include only 80% of the inventory. That is 80% of 2 lakh rupees. So we need to add 80% of 2 lakh. I hope you understood till here. Now comes the last part. The 2 lakh is sale value, guys. So when you do 80% of 2 lakh, you would have got sale value of goods and on return on approval. Simple, eliminate the profit element and include it in inventory. Let me show it to you as to how it's done. I need to add goods sent on return on approval basis. I'll write at selling price, it is 1,60,000. How sir? 2 lakh into 80%. 100% should be included, 20% is already included. So now I'll include only balance 80%. 2 lakh into 80% is 1,60,000. I'll eliminate the profit on the same, which is 1,60,000 into 20%, which is 32,000. If I eliminate which, I'll get 1,28,000 to be the value of cost of goods sent on return or approval basis, remaining unsold with the recipient, not included in our inventory on 7th of April. So now included in determination of inventory to be shown in the balance sheet on 31st of March. Got it? This is a right choice of question that you guys have asked me to solve, guys. Very interesting, nice one. Language is beautiful, adjustments are amazing, and brushes up almost every aspect of the inventory valuation to you people. Done. So by this we have successfully completed this adjustment D. Let us now go to adjustment E. On 27th of March, goods of sale value 2 lakh were sent on consignment. We are sending them. When we send the goods on consignment, we are consigner. The recipient is consignee. We have principal and agent relationship. I am not transferring the ownership of goods to consignee. I am only transferring the possession of the goods. As a consigner, I am only transferring the possession of the goods. Consigner will have the ownership. Consignee has only possession. So if I send the goods on consignment, though the goods are lying in consignee's go down, the goods belong to me, and I would have to include it in my inventory. I would have to include in my stock. Though the goods are lying with consignee, stock belongs to me, and I would have to include in my inventory. Great. 80% of these goods has been sold on 6th April. Very good. It is sold on what date? 6th April. On 31st of March, has any part of these goods sold by our consignee? No. I sent 2 lakh worth goods to him on 27th March. He sold 80% goods on 6th April. But as on 31st of March, has there any goods being sold? No. So entire 2 lakh worth goods is lying with him on 31st of March. Am I right? So entire I would say 2 lakh rupees is my stock. I would have to include it. Sir, isn't it part of this 4 lakh? You tell me, these goods are sent on consignment basis. These goods are with consignee in consignee's go down, even on 31st of March as well as 7th of April. On 7th of April, when I count my physical inventory in my go down, it is 4 lakh. This 4 lakh is the inventory that is there in my go down. I have the physical control, possession of these goods. This goods sent on consignment is with consignee. I don't have the possession. So this 4 lakh doesn't include these goods which are sent on consignment. But this stock belongs to us. Because it belongs to us, it should be part of the inventory which I should write in my balance sheet asset side. But it is not there in 4 lakh. So what do I do? Add simple. How much? Entire 2 lakh. Lot of them will do this wrong. They will deduct 80% and add only 20%. Why, boss? 80% is sold on what date? 6th of April. What date are we identifying value? 31st of March. 31st of March, inventory sold is 0. Entire 2 lakh is there in the godown. Entire 2 lakh belongs to us. We are going to add entire 2 lakh into our inventory. There is small catch. The 2 lakh is sale value. They have given sales value 2 lakh. So we will eliminate the profit element at 20% and then take it. So we'll write sale value 2 lakh minus profit 20% 40,000. 1 lakh 60,000 will be taken into our inventory. Let's do that. Come on. E. Goods sent on consignment. Remember, it is sent, okay? At selling price, I'll write 2 lakh less profit 20% of 2 lakh, that is 40,000. I am going to take 1 lakh 60,000 into my stock. Got this, boss? Done. By this, we are done with this adjustment. Let us go to the next adjustment. I think last one. Oh, just one more left. What is the last one? On 28th of March, goods costing 2 lakh were received for sale on consignment basis. In this part, we are receiving the stock on consignment. We are receiving it. We are consignee. We are the agent and we are working for some other principal for commission. We are agent. Now, when we are agent, we only have possession of these goods received on consignment. We don't have ownership of these goods received on consignment. We only have possession of these goods received on consignment. We don't have ownership. So this stock which we received on consignment is not part of our inventory. Should not be part of our inventory. We should not take it to our trading account credit side. We should not take it to our balance sheet asset side. Though we have the possession, we don't have the ownership. We don't have the control. We are acting as an agent for a principal who is giving us commission if we sell these goods. But this goods of 2 lakh, if it is remaining unsold, it will be there in our godown. And when we are trying to value our inventory by physical verification counting, we will count that also. That should not be counted. That should be eliminated. Got it? Now see, on 28th of March, goods costing 2 lakh were received on consignment. 80% of these goods has been sold by 6th April. We have sold 80% and we don't have to adjust it like sales. Why? Not our sales. I am after all an agent working for commission. This is sales made by me, the consignee, on behalf of our principal consigner. He is the consigner, I am the consignee. He is the consigner, I am the consignee. I am the agent having possession. He is the owner getting profit. I execute the sales on behalf of him. So this 2 lakh belongs to him, not me. If I sell these goods, it is his sales, not mine. So sales adjustment is not what we should do. 2 lakh worth goods are given by him. We have sold 80% of this. What is left with us is 20% on 6th of April. On 7th of April, when I count the stock like this, I would have counted 20% of such goods. What is remaining with me, which should not be counted. How much is 20% of 2 lakh? 40,000. 40,000 is wrongly included in our inventory here. 4 lakh. It should not be. So what do we do? Eliminate, minus, khatam. Let me repeat. 2 lakh rupees is the goods received on consignment. I am consignee. I only have possession. I don't own it. 80% of the stock is sold. 20% of the stock is remaining on 7th of April in my godown. Because 20% of the stock is remaining, when the physical verification is done on 7th of April, that 20% is included. So this 4 lakh, which is our starting point in determining stock on 31st of March, includes such 20% of 2 lakh stock received on consignment, which is not part of our stock. So we should eliminate it. So I will do 2 lakh minus 80%. That is 2 lakh into 20, basically 40,000. Should I eliminate profit on this? No. Why? Profit and loss to him, selling price to him. I am an agent, 2 lakh rupees is cost. Ashte boss. And that profit is to him. I don't care about the profit here. You get that? So let's do less goods issued on consignment. How much? 2 lakh minus 80%, which is 40,000 rupees. This has to be deducted and I will deduct this. And that is the end of the question. Number one, they've told goods sold by trader is at profit of 25% on cost. That is 1 by 4 on cost, which means 1 by 5 on sale. 1 by x on cost is 1 by x plus 1 on sale. That's what we adjusted at 20%. And they've told sales referred to in DEF are not included in BR. That's what even we would assume in the absence of this adjustment. So we have done it all. Let's quickly see what is the answer. 4 lakh minus 1 lakh 60 plus 1 lakh 28 plus 1 lakh 60 plus 1 lakh 28 plus 1 lakh 60 minus 40,000. This will give us the answer of 7 lakh 76,000. This, my friends, is the value of inventory as on 31st of March as per our records, and this is the inventory which should be taken in evaluation of financial performance and position. Meaning in this question they've asked this what is the inventory to be taken to balance sheet, and this is the inventory which I should be taking to my balance sheet. You get this? Stock to be taken to balance sheet as on 31st of March. That's it. This is the answer to this question. I hope you understood. I'll show the question for a brief moment if you want to take a note of this question. And I'd also show the answer later for you to copy or take a screenshot if you want. I can also share this Excel sheet with all of you people. You can just drop into me in the comments or get in touch with me. You can just find me like on any profile that you are on. Just search for CA Rajavardhan or accounts man and you'll find me. Yeah. So this is the question that we just solved. And there we go. This is the answer. Thanks for asking me to solve this question. And in the next in this series I'm coming out with a video on question of Hanuman Limited. It's a question from our ICAI material. As I mentioned before, it is a question which will involve valuation of inventories as well as rectification of income, rectification of errors. So what item will affect stock, what item will affect profit, and what adjustments will affect both. That's what we'll be basically trying to determine. So please stay tuned and then watch that video as well. I'm going to do one master problem from each of the chapters. In the past, I've already done it on NPO, and now we've done it on valuation of inventory. Before this, I did one on BRS. I'll be coming out with the master problem on final accounts very soon, and company accounts, and every topic of your syllabus. So please stay tuned and then watch it and help yourself in this exam preparation. That's it, guys. Remember, life is not a battle to be struggling, it's a game to be enjoyed. Till the time you're learning something, you're having fun, it's all good. The day you guys either stop learning something new or stop having fun, trust me, you might start struggling because you might be in a battle. So, the thumb rule to stay happy is pretty simple, it is to stay in the game. So, for one last time on this day, I have just one simple question for all of you. Are we in the game? I hope your answer is yes, we are in the game. See you all in the next one. Till then, tata, bye bye, take care, and get lost.